Rent a 10 by 10 storage unit at 65 and it bills you $45,000 before you turn 85. Nobody ever sends you that bill. No envelope, no due date, no decision. The card on file pays it, quietly, month after month, and storage is only number 3 on this list. Not one of these was reckless. Each one was a signature that felt responsible the day you wrote it. Protection, or convenience, or the sensible thing a careful person arranges in advance. Then the reason expires, and the contract does not. 5. Counted down. Easiest to cancel first, hardest to escape last. Insurance add-ons, extended warranties, storage, memberships, and the dues attached to your deed. Give me 15 minutes. You will know what each of the 5 costs across a retirement and the one call or one document that ends it. Here is the multiplier all 5 run through. A recurring charge is never only the charge, because the same money left alone would have grown instead. At 6%, an illustration rate, not a promise, $100 a month is not $24,000 across a retirement. It is closer to $44,000. I am your guide to real-world retirement decisions, and I cannot see your statement. You can. That is the whole advantage here. One favor before we start counting. If you want this arithmetic landing in your feed, like and subscribe now, and the next one comes to you without you going to look for it. Number 5. The writers you are still paying for. Start here, because this one is a paperwork problem, which is the good news. So what is actually riding on the policies you already own? A rider is a small add-on bolted onto a policy you already have. Extra coverage, priced by the month, that never arrives as its own bill. It hides inside a bill you were going to pay anyway. Go looking, and the same household usually finds the same handful. Roadside assistance bought 3 separate times, on the auto policy, on the credit card, and again from the dealer. An accidental death rider added when the kids were small. Credit life coverage attached to a car loan that has since been paid off. A phone protection line on your wireless bill for a phone you replaced years ago. None of that is a scandal. Every one of those was sold as prudence, and each is small enough that canceling it never makes it onto a Tuesday. But the Consumer Financial Protection Bureau has documented what happens when nobody looks. Its examiners found loan servicers still charging borrowers for add-on products after those products could no longer do anything at all, after a loan was paid off or the vehicle was gone, and failing to chase down the refunds those borrowers were owed. In one enforcement action, the bundled add-on products financed into those loans averaged $700 to $2,500 per loan. Now put a number on your own version. Say $60 a month, across the whole household. That is $14,400 over a full retirement. And if you had invested it instead, closer to double that. The fix takes one phone call, and it is the easiest on this list. Ask your insurer to read you every optional coverage on the declarations page, out loud, and say what each one costs. You are not looking for the expensive one. You are looking for the one you are buying twice. Number 4. The extended warranty that outlives the thing it covered. Why does a warranty keep costing you after the item is gone? Because it was written to renew, not to end. Start with the version everyone recognizes. The Federal Trade Commission's own guidance is blunt about it. An auto service contract, what the showroom calls an extended warranty, is optional. It is sold by dealers or by outside companies, and it is often tucked into the stack of closing paperwork without ever being discussed with you. The household version is quieter. Appliance and electronics protection plans bill monthly, sometimes on the utility statement, and they renew on their own for as long as nobody stops them. That means the plan can outlast the dishwasher. People sell the car, replace the refrigerator, and keep paying the plan attached to it because the charge never changed shape when the appliance left the house. Here is the thing about the coverage itself. That same FTC guidance says vehicle service contracts typically do not cover accident damage or normal wear and tear. Household plans run their own exclusion lists. Maintenance, misuse, cosmetic damage, whatever was already failing when you signed. Wear is what kills an aging machine, so the failure most likely to reach you is often the one written out of the contract. Run it. $75 a month in plans across your household is $18,000 over 2 decades, and getting on for double that if the money had been invested. 2 moves. Before you buy another one, check whether the manufacturer's warranty or the credit card you paid with already covers the same repair. Duplicated coverage pays once, not twice. And on a vehicle service contract for a car you no longer own, call and cancel. Refunds on those are generally prorated for the unused term, but you have to ask, in writing, and keep the copy. Number 3. The storage unit. What is actually in the unit? Most people cannot answer without opening the door, and that is the whole item. The unit is rarely rented for storage. You rent it for a few months during a move, or after a downsize, or the week a parent's house had to be emptied, and nobody could face deciding yet. The unit is not holding furniture, it is holding a decision. Then it renews. $140 a month, and the introductory rate is the hook. These leases let the operator raise it on a tenant already inside. Carry that at 3% a year, and the 20-year bill is just over $45,000. Sit with the comparison, because it is the one that stings. That is almost certainly more than everything inside would bring at a decent estate sale. You are paying rent on possessions that would not cover a fraction of their own rent, and paying it in your highest value years. And if you had invested that rent instead, it would be worth well over $70,000 to you now. There is a second cost nobody prices. The unit postpones a job your family inherits anyway. If it is still rented when you die, someone is doing that sort on a deadline, in grief, paying the monthly charge the entire time they do it. So take one Saturday. Not to empty it, to inventory it. Photograph every row, then apply one rule. If you cannot name what is in a row without looking at the photo, it is not storage. It is a decision you have been renting. Number 2. The memberships that renew themselves. Which of these did you actually choose this year? That is the only question that matters here, because these contracts are built so that saying nothing counts as saying yes. That structure has a name. Regulators call it a negative option, meaning the sale continues automatically unless you take action to stop it. It is legal, it is everywhere, and the federal rules around it have been written, challenged, and rewritten more than once. So do not wait for a rule to rescue you. The friction is yours to manage. The stack is predictable. Streaming services that each raised their price twice while you were not looking. The gym membership from a New Year's resolution several years ago. The upgraded warehouse club tier. Alarm monitoring on a system that no longer talks to the panel. A magazine or newsletter that renewed at full rate after the introductory year. Call it $185 a month, rising 4% a year as the price hikes stack. That is $66,000 over a full retirement, and close to double that if you had invested it. This is the rare one with no sacrifice in it. You're not giving anything up. You're stopping payment on things you already stopped using. Do it in one sitting. Pull a year of your own statements, highlight every recurring charge, and for each one answer a single question. Did you decide on this in the last 12 months, or did it just continue? Cancel the ones that just continued. If you miss one inside a month, resubscribe. Almost nobody does. Number 1. The dues attached to the deed. What changes when the bill is attached to your house instead of to you? Everything, because that is the one contract on this list you cannot cancel by making a phone call. Picture the decision the way it actually gets made. You're 68. The stairs are getting old, the roof is a worry, and the community across town handles the lawn, the snow, the exterior, and the pool. Buying in is not indulgence. It is the responsible move made in advance. The scale here is not niche. In 2024, about one owner household in 4 in America paid a condo or homeowners association fee. For owners with no mortgage left, which is to say, for many retirees, the median came to $184 a month. But the median is not where the damage is. Roughly 3 million households were paying above $500. Nobody moves in at the top of that range. They arrive near the median and get carried there. Take a community at $425 a month, rising 4% a year. A stress test, not a forecast, and the number to assume until the dues history proves otherwise. Across a 20-year retirement that is roughly $152,000. By the final year, the monthly bill is near $900 on a fixed income that never grew anywhere near that fast. Invested instead, that money would be worth past $250,000 to you. But the dollars are not the hard part of this one. The hard part is that the obligation is not yours to end. You can quit a gym. You cannot quit an association while you hold the deed, and depending on your state, an unpaid balance can become a lien on the property itself, with remedies set by state law, not by the association's goodwill. Then there is the charge the brochure never shows, the special assessment. That is a one-time levy the board votes when a roof, an elevator, a seawall, or a parking deck has to be replaced and the reserves will not cover it. You owe your share whether you ever use the elevator, and it arrives with a due date, not a negotiation. One more piece that separates this from every other item. A subscription dies with you. Dues run with the property, so they keep billing the estate every month until the unit actually sells, and heirs carrying that charge tend to accept the first offer. So do the diligence before you sign, not after. Ask for the dues history going back 10 years rather than this year's number, because the trend is the product. Ask for the reserve study. That is the document that says whether the association has saved for what is going to break. And read the last 3 years of board minutes, which is where the assessment nobody has announced yet is already being argued about. If the reserves are funded and the trend is calm, those dues are buying real services at a fair price, and a house without an association still needs a roof and a lawn. This is not an argument against the community. It is an argument against budgeting a rising bill as if it were flat. 5 contracts. Not one of them was a mistake on the day it was signed. No household carries all 5, and it does not need to. Take just 2 from the middle of the list, the unit and the memberships, and you are at $111,000 over a retirement on things nobody chose this year. So carry 2 questions out of this video instead of 5 numbers. What does this cost me every year for the rest of my life? And did I actually decide on it in the last 12 months, or did it simply continue? Your assignment is one statement. Pull a single month. Find every recurring charge on it, and cancel one before you go to bed tonight. 1. That is the whole task, and it gets easier the sooner you start. This is education, and it is not financial advice. I cannot see your policies, your association's documents, or your state's rules, and those specifics are exactly where these decisions get decided. So take your own paperwork to a professional who can read it with you. If this made you think of one charge you have been carrying, hit like, so it reaches someone who is about to sign the same thing. Subscribe, so the next one gets to you before the next renewal does. And put the word canceled in the comments once you have killed the first one. I read those, and they are the reason I keep running this math out loud. Money that leaves on autopilot is the only money you never get to decide about. Take the decision back